people will make that contribution, report it on what they call a Form 8606. So you're telling the IRS, hey, I'm not taking the tax deduction for this contribution to my traditional IRA. File that, and then you can take that, and I mean, this can happen all pretty much simultaneously, at least in the same year.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe.
Hey, are you confused about IRAs or maybe even heard of SDIRAs and unsure of what they are or where to begin? Well, stay tuned because I have the perfect guest for you today. Joining us is Collin Taylor, an IRA specialist at Quest Trust Company, who will shed some light on the world of IRAs and help you make informed decisions around retirement future and building wealth through these entities. Collin was born and raised in Houston, Texas, has been in real estate investing for a long time. He graduated from Texas A&M University with a degree in agricultural economics with a focus in finance and real estate and a minor in financial planning. Before starting the Quest, he spent the first part of his career doing comprehensive financial planning for some small IRA companies. So by the end of today, we're going to be talking about what an SDIRA is, who can use them, why the SDIRA, where you can get them and leverage them, and touching on many of the other how questions. So if you're ready, let's dig into the episode of today. Collin, thanks so much for being here. As you know, we were just chatting about the audience is tech professionals that are in some of the, FANG or MANG companies, but also tech professionals in general who are interested in investing in real estate. And, I remember the first time learning about this topic, and as I continued to grow my knowledge around the topic, my first questions were, IRA? I didn't know what an SDIRA was, but why would I even be thinking about an IRA, and how is that related, to real estate investing? So, walk us through, what is an SDIRA?
Yeah, absolutely. And I guess just to start, Steven, it's a pleasure to be here. Thank you so much for having me on. We, not only myself, but Quest, my group, we care so much about, trying to provide the education. So this is something that we find really close to heart. And to, I guess, dive into some of the basics about these self-directed IRAs, about Quest as a custodian. Truly, the term self-directed is really just used for marketing purposes. There's really not a difference from the standpoint of the IRS. You won't find anything about self-direction in the tax code. The legal distinction between the IRAs we have and ones that you would find anywhere else, Fidelity, Schwab, Merrill Lynch, TD Ameritrade, you name it, right? There's a bunch of big brokerages out there. There really is no true legal difference in the accounts that we offer and those elsewhere. What really makes them unique is the asset selection that you have to choose from. So we're really just enabling people to use their retirement funds that they have elsewhere and put it into some more alternative-based assets.
Awesome. I appreciate that. And you sort of defined it there along the way. You're saying it's self-directed, right? So, but you also mentioned some of the other custodians, where those other companies like the Fidelity and Schwab, et cetera. And, for the sake of just getting an understanding of the comparison, what do those allow you to invest in? Many of us should know already, but let's just, make the contrast. What do they allow you to invest in? When you talk about alternative assets, obviously we're here talking about real estate, but what are some of the other things that come to mind?
Yeah. So a lot of the really popular things we see here, like you said, real estate is a big one, whether that's, short-term, long-term rentals, multifamily, single-family investments, all those kind of things. We also see a lot of private lending, so people lending out their money to sometimes other real estate investors who need it for a project or what have you. Mineral rights, oil and gas investments, cryptocurrency, sometimes small or privately held companies as well.
Right. Okay. So all of those other things you mentioned, the different forms of real estate, asset types, private money lending, when you're talking about alternative, it's really just, is it fair to, just simplify for the most part, broad strokes, and say it's anything but like stocks and bonds in the public market? Is that about right?
Yeah, for the most part. So there are really two types of investments that you can't do through an IRA: life insurance contracts and collectibles. So vintage cars, playing cards, jewelry, artwork, things like that, right? Outside of those things, an IRA can really invest in just about anything you could do personally. It's just that you're going through the means of using a tax sheltered account or vehicle to do it, which is where Quest or a custodian comes into play to kind of help facilitate that.
Got it. So with the SDIRA, I can invest in pretty much anything I want to. With some of those types, which I'll ask a question in a second. But Quest as a custodian will help to make sure that even though I'm self-directed, I'm still following the correct guidelines by IRS or just other laws that I may not be aware of or know about as much. Is that about right?
Absolutely. And that's part of what my role is here as well, is to kind of provide that education to help people know what the rules are, what are the restrictions, what can I do, what can I not do. And part of our kind of review process of investments is making sure people are kind of abiding by that as well.
Got it. I definitely want to get into that because I know, you and Quest do offer a ton of education. There's, I think even on Saturdays, there's the webinars as well, et cetera, et cetera. There's so much information. Good thing, right? But also talking to people like yourself to help focus on what things kind of, even in tech, there's so much information, just knowing what to focus on is half the battle and where to allocate your time. And so before we move on, I'm kind of curious. You mentioned collectibles and another asset that we can't invest in. Can you just talk about briefly why those topics were things, or those assets were things that cannot be invested in?
Yeah, there's really not a whole lot to explain there. I mean, because the IRS says no is really what that comes down to.
Yeah.
But yeah, outside of that, I mean, we handle just about any kind of asset you could think of outside of the stock market and some of those more traditional things.
Got it. Yeah, I think one of the answers that I heard, and I just sort of curious about asking you here too, is that, the collectibles and stuff, their value is a little bit more subjective, right? Is probably something along those lines, if I had to speculate.
And that's very true as well. Obviously, it's, you could have somebody appraise a piece of artwork. Two different people appraise a piece of artwork and come up with completely different values. So yeah, for that reason too, I mean, it's kind of hard to keep in an account where there is supposed to be valuations reported and things like that to the IRS.
Right, the valuations reported. What is this actually quote unquote worth? Okay, got it. So with the W-2 or the jobs that we have as employees, right? We have our own IRA that has a custodian that is usually, we have some choice, but it's usually chosen, for maybe employees already. Using that, we can typically invest in like a stocks or bonds or some type of, combination, right? Funds, target funds, and, other things. But with the SDIRA, we'd go to a custodian such as Quest or other as well. That would allow to take the cash and go and invest in one of these alternate assets, right? And so, great. So that is solidified. So how do I get the money in Quest? Like, how do I get the money in the SDIRA? What would I do? Like, for those like myself, hopped around some different jobs in the past. I have had, cash in an IRA, right? Somewhere else that was just sort of sitting there. So sort of leading you here, but there's, are there other ways to start building an SDIRA account?
Yeah, certainly. So after, initially setting up the account, we break it down into 3 different ways that you can fund it. So the first one would be a contribution, which is subject to contribution limits based on the type of IRA. So it could be smaller for a personal IRA, like a traditional or a Roth, sometimes quite a bit larger for those employer-sponsored IRA plans, SEP IRAs, simple IRAs, things like that. So contributions, we're talking about money coming straight out of your own pocket, right? Typically, maybe a checking or savings account that you have. It's not already qualified money from another plan, right? So you're taking money out of your pocket, making contributions into the IRA based on those annual contribution limits, and you can build up an account that way. The other two would come from pre-existing retirement accounts. So a transfer from another IRA is something we see very commonly. Transferring money from your account you have at, like I said, Schwab, Fidelity, wherever it's at, since the accounts we have are no different. You can transfer that over pretty seamlessly. The second would be a rollover, which I guess people oftentimes kind of confuse the two. Rollovers normally speak more specifically to employer plans, your 401k, 403b, TSP, TRS, sometimes 457, right? There's a bunch of different plans out there. And typically it's when you have actually what they have a separation of service from that employer. You quit, retire, switch jobs, whatever it is. You're able to now roll over that no longer active employer plan to an IRA. And the reason that I highlight that it should be an inactive employer plan is because most of the time when you are still working for that company that's sponsoring the plan, you can't take that money out. There is certain stipulations. Sometimes certain plans allow for what they call in-service rollovers, meaning that while you are still in service working for that company, you may be able to move out some of the funds. Again, it's really just depends on the plan and what that allows for. So it's really not anything that we can kind of make as a generalization.
Sure. Got it. So the number two here in general is that rollover from one of those other types of plans you mentioned to the SDIRA, or just the IRA in general. And was there a third one? I saw you said there was three.
Yeah, contribution, transfer from another IRA, and a rollover from an old employer plan.
Got it.
Yeah.
So you touched a little more on what that transfer and the difference of the transfer and rollover. Was the transfer just from like IRA to IRA, or I got a little confused there? Yeah.
So and they are a bit confusing because they seem very similar. It's money moving from one qualified plan to another. Right. Transfers are, like I said, a little bit more seamless because it can only happen between IRAs, traditional IRA to traditional IRA, Roth to Roth, whatever that.
Got it.
One thing that's really nice about a transfer is, as opposed to rollovers, they're not. Technically, you can do it either way without incurring taxation, but transfers are actually not even reported to the IRS, whereas a rollover technically is.
Got it.
There are two, and part of the reason is that there are a couple different ways you can do a rollover. You can do it direct, where it moves straight from one custodian holding the plan to another. You can do it indirect, where you actually take receipt of that money first before moving it back into a qualified plan, which is kind of why that movement is actually reported, so that the IRS can see, hey, maybe I took $100,000 out of the 401k here, but I put it back into another IRA, so it's still maintaining that tax deferred status.
Yeah, and that's exactly what I did too. I got a really, really big check from one place, and I was like, well, I should probably deposit this somewhere else. That was the plan. And so funding, the transfer, and then the rollover were the three. Right. And then, like you said, I think the key point to emphasize is that on the self-funding, like you said, that the constraint or the quote unquote restriction is the amount that you can fund on an annual basis. Right.
Yes. Yeah. The contributions.
The contributions. Right. As of right now, I think we still have till it's like 3,400 or so for the year. If I remember correctly, right around there. Yeah, for 2024, the like traditional and Roth contributions are $7,000. For those over the age of 50, the IRS allows for what they call a catch-up contribution, not mustard, but catch-up, of an extra $1,000. So you can put in $8,000 over that threshold. And actually, for somebody who didn't make contributions for 2023, that they can still do until the tax filing deadline. So you always have a little bit over a year to actually make your contribution. So it's
2023 will be due April 15th of this year.
April 15th. Got it. So basically what that means is if I wanted to open up an SDIRA right now, then I could still contribute that total of 7,000 amount for 2023 and an additional whatever the amount is for the 2024 as well.
Yeah,
is that right?
Yeah, absolutely. So you could be looking, and they did increase the contribution limits a little bit this year. So last year it was 6,500 to 7,500. Now this year it's 7,000 to 8,000. So you're potentially looking at a total contribution of at least $13,000, $14,000 depending on kind of what your age is.
Got it.
For
yeah, I appreciate that. It's a really good call out because one of the things that I was hitting too is, okay, I transferred or I rolled over a bunch and I've been funding a little bit, but also how do I grow this more versus just, moved over some money and I'm putting in some money every calendar year, every fiscal year. Right. Sure. And so it's like, well, what do I do? And so I think this speaks a little bit more to the value around what you can do, with the SDIRA anyway, versus just having a chunk of cash somewhere that's like, yeah, I know it's there, but I'm not doing anything with it. And so like that's one of the main value propositions, the main points anyway. You can go and invest that money, right? So, with whatever you're willing to share or however you can talk about this, how do you see people using their funds to invest? I mean, you talk about some of the different asset classes, but what can you share about how people are using their funds? And I don't know. I wanted to ask something along the lines of returns. I know we're not talking about like returns specifics or anything, but just how do you see clients using their SDIRA? I think just to paint that picture.
Yeah, that's a really good question, and certainly pretty broad too, right? There's all different kinds of things that you can do. I would say aside from some of the different asset types that we've kind of already talked about, there are a lot of different ways we see people structuring their IRAs and their investments as well. Partnering is an extremely popular strategy that we see people use. So if, say, Steven, you and I want to take both of our IRAs, partner them together and go in 50-50 on a rental property that we're going to, rent out, receive the income from tenants and things like that. That's absolutely something you can do. And kind of creates a very stable way to add additional capital, maybe not necessarily into your IRA account, but into a deal, right? Whether we want to, buy that outright, go into like a joint venture agreement, fund it through some kind of corporation or LLC. There's all different kinds of ways you can do it. And that's kind of where an attorney would come into play as well, right? With the structuring of things. But partnering is extremely popular.
Yeah, I know that was a broad question. I really appreciate the way you answered that because that is the better question to follow up on is that, it's really here's how it can be done, right? And so the partnerships, whether that's, in this example, you and myself to go and buy, a piece of real estate together and both benefit from, the cash flow or whatever the benefit is that good system. But that can also be done if someone wants to go and in other assets that you covered as well, the single family or multifamily, if they wanted to invest with funds that they might have rolled over or however they've funded right into the SDIRA and they're put in their own cash as well to go and become a limited partner in passively in a deal. That's also a possibility, right?
Yes. Yeah. Active versus passive investing is certainly a pretty big topic here as well. That was sort of what you were asking, right?
Yeah, exactly.
And there are, depending on like your time availability is obviously a big factor in all of that. You have the time to put into, maintaining a rental property or something like that versus just investing in a multifamily project where there's obviously a group that handles that for you, whether they're constructing apartments or condos, something like that. So those passive investments are very popular, especially for people who maybe have some access to their 401k. They're not just yet retired; they're still working, don't have a lot of time to keep their eyes on the real estate market or around their city and see what's up for sale. So those passive investments are quite popular too.
Yeah, it definitely takes a lot of time, certainly. But it's a good call because like you said, that speaks on the active and passive part. So you can use it for any active deals if you want to use just the funds itself that might be in the IRA, or you can use some of the IRA funds and own cash as well to go into a deal, whether that's active or passive. Other structures would be like if you and I went into a deal together, and that could be if there's multiple people as well, right, that want to go into a deal, they can use multiple partners. Is there any limit around that?
Not necessarily with the number of partners, and partnering in general. There's typically not limitations around, and I'm not sure if we want to get into just yet like the different investment restrictions. What can my IRA invest into, or more specifically, who can it invest?
What are things that some of the restrictions, constraints, if you will?
Yeah, so we normally break it down into 3 different restrictions or limitations that the IRS places on these accounts. So the first one is the people restrictions, or who my IRA cannot invest with. And this would include you as the account holder, your spouse, your lineal ascendants and descendants. So anybody up and down the family tree, right? Grandparents, parents, kids, grandkids, spouses of your descendants. So a son or daughter-in-law would kind of fall in there. And then it also extends to any company or entity that those people either own, operate, manage, or are highly compensated by. Which is kind of some fancy IRS lingo. The way that I normally explain it, just kind of in more plain English, is it includes you, spouse, anyone up and down the family tree, and the companies that they're associated with.
So basically, if you know them and you think you're related to them, you probably should choose your IRA.
To some extent, it's at least worth raising concern, right? And so what these people cannot do kind of falls into that second restriction, which is the prohibited transactions. Sort of, I guess, denotes what your IRA is not allowed to partake in with these disqualified persons. And that would be any kind of buy, sell, a loan or exchange, or providing a service or benefit to the IRA, or even an IRA to that individual. Or entity. So kind of what that looks like, I guess just to give a few examples, I couldn't take a property that I own personally and sell it to my IRA. I could not use my IRA to make a personal loan to me. All of those things would be considered prohibited. But notice in both of those examples, I'm on the opposite side of this transaction from my IRA, or on the opposite side of this deal. So, right, my IRA is loaning me money. I'm the borrower. My IRA would be the lender. In the event that I wanted to partner with my IRA, that is something that can be done. So if I have, some funds in my IRA, some personal funds, and I kind of want to partner those together to hold a real estate property, that can be done because we're on the same side of that transaction. If that makes sense.
That does make sense. I guess the part that is, I think, through that logic then, is that even if you're on the same side of it, the lineage rules still apply, which means it doesn't matter if you're on the same side. You still could not invest in any deal that you're with someone you're related to.
Correct. Yeah. Now I could say take personal funds, my IRA funds, and maybe my parents, want to invest their IRA funds too. We could all partner together, but it's still not going to make a difference in who we invest with when those prohibited transaction rules come into play, and who is disqualified from that.
Got it. So expanding that a little bit, just to provide a couple bullet points here, it's that I am not going to invest in any buy purchase with anyone that I'm related to, right? With the IRA, I cannot have my IRA in any transaction where it would receive funds of a sale, right? Based on anyone in my lineage, right? And also, I'm not allowed to have my IRA lend any cash to anyone in my lineage as well from the IRA.
That's correct. Yeah.
Okay, got it. So I know that was just an expansion of it, but I just wanted to make it super crystal clear. Just it doesn't matter if you're on the buy side, the sell side, or the basically financing side of lending money. It just can't be anyone that is in your lineage.
Yeah.
Okay. So all that to say, invest in other people's deals.
Yeah, that's a great way to look at it. And normally the way that I kind of explain it to people is that I guess best practice or best rule of thumb is, just keeping the money separate. Some people do like to partner with their IRAs, and normally that's pretty kosher. But the further you can keep IRA and qualified money from personal capital, oftentimes the better.
Qualified money. Can you define that for us?
Yeah, qualified, referring to like money in some kind of tax sheltered plan.
Got it.
401k,
Okay.
IRA, anything like that.
Okay, cool. So I know what this thing is. I have, I know that I can invest in these different types of assets. I have a pretty good idea now as the listener on all the things I can't do, speaking about those different examples throughout lineage. But at this point, I have still learned the different ways I can fund it, through contributions, through the transfer, through the rollover. And I'm thinking, great, I can invest. I go through all the trouble to invest in something. How do I even access this? When do I access this money? How do I access the cash? It's like, if it's an IRA, do I still not get any of the cash benefits that, of this account that I'm growing until retirement age? What is the benefits of me going through all of this trouble in 5 years and 10 years, 20 years?
Yeah, sure. So, eventually, and you have to think about, really what the IRA is. It is a retirement account, right? So it is for the purposes of investing, saving for your retirement. Now, you may have access to that cash, with taxation and penalty, even before you're kind of at that retirement age. But the purposes of it is to actually be able to invest and save for retirement, I guess, a little bit more effectively than you could do outside of an IRA, right? That tax advantage is the main reason why we see people use an IRA account versus, say, just taking $100,000 that they have personally, investing into a multifamily project. That's the whole reason you would do it through an IRA, is to allow that money to grow tax deferred. All the profits returned to the account, still tax deferred. You can reinvest that money, again, tax deferred. So the advantage you have of kind of being able to grow that account without having to pay taxes can be pretty unbelievable. And you're essentially deferring all of that depending on how the account is structured or what type of IRA you're using. Normally, you're not paying taxes on that money until you withdraw, right? Once you're in retirement, you start needing that money to live on. That's when you're taking distributions to kind of supplement the income you had in your working years.
Got it.
Which is what we know with a pre-tax type of account, such as a traditional IRA. Roth IRAs are pretty much the opposite. You pay the taxes on the money that goes into the account. So at the time of contribution, or if maybe you're converting from a pre-tax account like a traditional IRA to a post-tax account in the Roth IRA. So Roth IRAs are all post-tax contributions, post-tax funds that allow you to grow the account. And eventually, once you're taking distributions, you can take everything out potentially tax-free. Not just the money that initially went in, but the growth and the return that you received on your investments as well. So that growth bucket in the Roth IRA is what makes those so advantageous, because that's money that could potentially never be taxed.
Right. Yeah. There's some good questions, I think, there as well. The first question, since you bring up the traditional and the Roth, is the SDIRA. this traditional, or is there also, such a thing as how would you say it, a Roth SDIRA?
Absolutely. Yeah. And kind of what I mentioned at the beginning, that term self-directed really is more for marketing. So, you can, and oftentimes we do advertise them as traditional self-directed IRAs and Roth self-directed IRAs. All of the accounts that we offer are self-directed. You have the control to make the investment decisions, do what you want to do. You really just need, like I said, a custodian to help facilitate it and kind of making sure you're doing things the right way. The IRA is taking title to those assets properly and all of that.
Got it. So in other words, to simplify that for me, you quest traditional IRAs and Roth IRAs, and you can definitely just get this find a way to fund a Roth IRA with Quest as well, right?
Yeah, and it's they're one of the most popular accounts we see right now, specifically because of that very unique tax advantage. And I used the word potentially tax-free a little bit earlier, right? Distributions coming from the Roth IRA. Do you mind if I expand on that a little bit?
Please, go ahead. Take it.
So, yeah, there's really two qualifications that you have to meet in order to take distributions from a Roth IRA tax-free. One is something that you always have to meet, and that's that you've had a Roth IRA opened and funded for 5 years. So it's not necessarily just enough to actually set up the account, but actually making a contribution into it. And that doesn't have to be each Roth IRA that you open. If you say have had a Roth IRA for 20 years that's been funded that long, then you've technically satisfied that requirement for all Roth IRAs.
Is that consistently year after year funded it, you mean? You're straight?
Not exactly, just that you made an initial contribution. It could be $1 into the Roth IRA.
Okay.
And that would start that seasoning clock, so to speak.
Interesting. Got it. Okay.
So open and funded for 5 years is the first. The second, there's a few different options on. Really the most common that we see is attainment of age 59 and a half, or you're 60 years old.
Right.
But there are other, like death, disability, sometimes medical expenses, education expenses that would qualify for that second requirement as well.
Right. Interesting. So 5 year seasoning period, and it has to be, you have to make contributions, and there's no, the only limit is it could be quote unquote $1 of funding year after year for 5 years. Yeah.
All you really need to do is make an initial contribution to that. So to start that seasoning clock, if that makes sense.
Yeah. What does that look like? The initial contribution? Is that some of the one of the three different funding ways that you talked about already? Yes.
Normally like contributions coming straight out of your bank account would be the way that people do it. But yeah, technically, if you have conversions coming from maybe a pre-tax plan, that could also potentially start that clock. Now that's kind of diving into a deeper rabbit hole, just because each conversion has its own 5 year clock, which I know is a little bit confusing. So that's sort of where, proper record keeping, proper bookkeeping really comes into play with these IRAs, especially with the Roth, because you want to track sort of each bucket of money.
I want to dive more into a particular strategy that I'm aware of, but I do want to go back and just emphasize that, the two different ways you were talking about distributions, we kind of went down that here of that 59 and a half age, when you're hitting that, and then the second one being, meeting that seasoning period with funding. So those are two different ways to receive distribution. So, like I said, I just wanted to emphasize for the listener here and for us, it's just that it is still a retirement account. The self-directed is basically marketing, and so the opportunity here is to grow. Have this money that's in this, this cash that's in this entity, right, recognized by the IRS, that we can grow through investing, right? It's like you have money piled up, you should do something with it, right? And so, yeah. So I just wanted to make that super clear because, the more money buckets you have, the more you do with it, the more that you can use at varying levels of your life, so to speak.
Right. Yeah. And to your point as well, that's, because the IRS has these limits as to how much you can put in an IRA every year, it really is worth it to take advantage of that, especially if you've got some cash set aside. In particular with a Roth IRA. The nice thing about those Roths, and just another of the many reasons that they're so popular, is you can take your contributions out at any time, tax and penalty free.
Hold on. So repeat that. With the Roth, I can take out my contributions anytime?
Anytime, tax and penalty free. So you have to meet those requirements to take out everything in the Roth IRA, tax and penalty free. But specifically the contribution, so the money that I'm taking out of my pocket and putting in that Roth, not considering the investment growth on that money, just the
principal
portion. Yeah, exactly. I can take that out at any time, tax and penalty free.
No kidding. So in other words, the example being is if I put in 20,000 and I don't know, let's just say I put in 20,000 and I go and put this in, put it into a piece of real estate and I get, 10% a year, on interest, right? And that grows to, the 2,000 or so every year. I can still take out 20,000 that I put in.
Correct. Yeah. And again, that 20,000 is not something that you could contribute all at once, right? Because of those contribution limits. So that's something else you have to consider. But assuming that you've built that up over 3 years or so, 4 years, then yeah, absolutely.
I had never heard that before. That's pretty cool.
Yeah.
Okay, that adds to another question. I should have got my notepad here. My mistake. I've got some notes I'm writing in front of me, but well, that's why we're recording this in an episode. Appreciate it, Collin. So, so the point still being, it's an account to accumulate wealth. One of the things that I was, if I'm a tech professional, I'm about to Google, or search whatever. Okay, well, I'm listening to this and it sounds really interesting, but according to what I find online, I make too much money for a Roth account. Right.
Yeah.
That's something you hear from others
all the time. And that's such a good point that you bring up too. And talking about what they call backdoor Roth contributions, right? So because the IRS puts, an income threshold on who can contribute directly to a Roth IRA, most people, and honestly, a lot of CPAs and accountants will tell you, just purely because they don't know, but you'll hear that you just can't do it. Can't make a contribution to a Roth IRA and make too much money. Too bad, so sad, right?
Exactly.
So the way that people can kind of get around that, I guess, is making what they call a basis contribution to a traditional IRA, or a post-tax contribution to a traditional IRA, even though they're pre-tax accounts. I guess this is getting a little bit technical, but people will make that contribution, report it on what they call a Form 8606. So you're telling the IRS, hey, I'm not taking the tax deduction for this contribution to my traditional IRA. File that, and then you can take that, and I mean, this can happen all pretty much simultaneously, at least in the same year, and then convert that contribution to the traditional to the Roth. So even though I may not be able to contribute directly to the Roth IRA because of that income threshold, the IRS doesn't have any limitation as to who is able to convert. So money that's pre-tax in another retirement plan could be converted into that Roth.
Perfect.
So that's kind of the roundabout way of doing that.
And is that typical? Is the traditional Roth, you said convert pre-tax dollars. So is traditional IRA the only one that you're seeing that conversion happen from, or are there different accounts as well we should be aware of?
Yeah, I mean, really, any pre-tax account you can do that from. Some people will roll, they'll take their 401k, which most of the time is pre-tax dollars, roll it over into a traditional IRA, and then maybe convert all of that or convert it in chunks so that they're not taking a huge tax hit on that every year. When you are converting from money that has not been taxed, you're going to have to pay tax on it, right? Money going into a Roth IRA is taxed at that point.
Right.
So some people will kind of use this strategy where they will say they make $20,000 under that next income tax bracket, if you get what I mean. So like say the 24% tax bracket is $200,000 of income. I make 180. Sure. I'm going to maybe convert $18,000, $19,000 that year before it pushes me into that next threshold. So that's very common. People will do it in chunks over a period of multiple years to kind of, I guess, limit how much they're being taxed there.
Yeah, that's a good strategy to pay attention to. Mm-hmm. It definitely takes knowing your numbers. Absolutely. You should know your annual income and other, AGIs, et cetera, but knowing, where you are relative to your tax brackets, how to minimize your taxes, right? Because if you were to convert 21,000, and that earn 180 and convert 21,000, it's still marginal, right? Like you'd pay that same tax bracket or pay taxes on that 20,000, but then the next tier up for that 1,000 that you pay, that you would also got it. Yeah. I guess that's why there's folks like you and our accountants to help out, right?
Yeah. And another really interesting strategy that I find pretty fascinating is something called a mega backdoor Roth.
Mega backdoor. Oh, yeah. Okay. I've heard about this.
This applies more specifically to self-employed people. And we talked just briefly about those employer plans, SEP IRAs, simple IRAs, where the contribution limits are a lot higher. So those are also naturally tax deferred or pre-tax accounts. But with the SEP IRA, for the contribution limit for this year is actually $69,000. So almost $70,000 you can put in that every year. It's based on what your self-employment income is. But if you're able to make that full contribution, you can convert all of that to a Roth IRA. So that's what they call the mega backdoor contribution.
Super interesting. I don't want to get ahead of ourselves there. I do want to ask, because it's a good point. So let's say I have an IRA, right, from an employer sponsored IRA plan, and I want to open up a Roth for all of the benefits of getting it taxed now, but having all that as after tax dollars in the Roth account itself. How do I go about doing this, right? You talked about the strategy, what it looks like, right? And, paying attention of how much you would roll over or convert, and paying attention to, the amount that you convert relative to your taxes. But how do I actually go about doing this backdoor Roth strategy?
Yeah. So, that certainly, I guess, depends a little bit on the custodian you're doing it with, right? And I can tell you from the Quest side what that looks like on our end. And this is, I guess, generally how it's going to be with any institution. But you have both a traditional and a Roth IRA set up at, your custodian of choice. Okay. You take that money out of your checking account, wire it to Fidelity or to Quest or whoever's going to be receiving it into that traditional IRA. So that's initially making the contribution.
So from that employee sponsored account, it goes into the individuals. They get the check that goes into I'll use me. If I had it, then I would get the funds from that IRA, have them send me a check so it goes into my checking account, and then I would send that money to the traditional IRA that Quest owns, that Quest is the custodian of first.
You're saying, well, if the money is already in an IRA, you could transfer it directly to us.
Got it. That's why I wanted to make sure of.
Yeah. So I guess I'm talking more specifically about a contribution. Now, if you wanted if you had money in another IRA, you wanted to transfer to Quest to kind of do this strategy, you could move it directly from them to us. There's no need to pocket the money in between. You know what I mean?
Perfect. That's what I was just making sure. So the use case is this is in an employer-sponsored IRA somewhere else. I haven't done anything with it, and I want to use the backdoor Roth strategy. So go ahead. Sorry.
Yeah, and so you move that money into the traditional IRA by whatever means, whether you're transferring it, rolling it over, or contributing to the traditional. And then the process to actually convert it is pretty simple. I mean, what that looks like for us, you complete a form, you let us know, hey, this is how much I want to convert. I want to, you have the option to withhold taxes on that. So if you want to use that conversion to actually, pay the tax, potentially you could do that. You could withhold nothing, which is, I would say, a little bit more common, especially if you're making a basis contribution or a post-tax contribution to that traditional IRA. You've already paid taxes on that money, so there's no need to actually do that, which is where that tax form that I mentioned earlier comes into play. Yep. But you I guess, instruct your custodian to make the conversion, and they move that money for you from the traditional to the Roth IRA. And with a post-tax contribution, you can get with your CPA or accountant at year end, have them help you file the 8606, and you're telling the IRS, this is the reason that I'm not paying taxes on this conversion.
Got it. Okay, cool. So in that event, if I contributed to that traditional IRA that I opened with Quest, right? And let's say there's 50 grand in there, 50K. And then I open up a Roth IRA as well, also with Quest as an example. And I want to convert for tax purposes only 25,000, half of it. Then I would still have 25,000 in that traditional IRA, and I would have 25 in the Roth. Mm-hmm. And so what that would mean is, because it's with Quest or custodian, right, I can still use both buckets of cash to self-direct and invest in other assets.
Absolutely.
Okay.
Yeah, and you're not necessarily limited because the money's separated in two different accounts. We talked about that partnering a little bit earlier. You can do the same thing with your traditional and your Roth IRA, partner them together to make one purchase or invest in one thing. It doesn't have to be completely split up.
Super cool. Thanks for walking through that with me.
Yeah, absolutely.
Yeah, and that's really cool because, the 20, however many years down the line or whatever, seasoning period you meet, right, for distributions later on, you would have been growing those accounts through investments anyway. And so why not just get more, right?
Yeah, absolutely. And Steven, it's such a popular tax saving strategy that it's good to know. So.
Yeah, I have a couple more questions before we close out for today. I think I just wanted to mention that going through this, all of this information in the strategy, inherently everything has risks. So even though we're talking about growing accounts, be wise, invest in right, assets, or invest in assets that you're aware of with people that like trust, all that stuff. Everything has risk, but that in mind, you can still grow your accounts. The thing I want to talk about next is just additional benefits. If this wasn't reason enough, and I'm kind of curious about this too, is can you talk to us briefly? Maybe we'll have you back for a second session, and there's so many topics we haven't talked about yet. But one of the purposes, mission, charter that I have is to help tech professionals grow their wealth through passive investing with real estate, right? Yeah. And so if we're talking about this strategy, then one of the questions is also, with the IRA and with the Roth IRA, what does this look like, past, through my estate? Can I pass this down to someone else? Can this transfer generations? What happens if I die?
Yeah, so no, there's that's a great question, and there is absolutely an estate planning mechanism in place in these IRA accounts. Mm-hmm. So you can actually list beneficiaries for the IRA directly. And that kind of serves as a way that it avoids probate or anything like that. Whether you want it to be inherited by a trust, and you have a trust agreement that kind of splits that up based on your wishes, or maybe you have all of the money going to a spouse, you split it between your kids, whatever is more directly, you can absolutely set that up. And actually, we require, not all custodians do, but Quest requires that you have a beneficiary when you establish the account, so that in the event that something happens, because, as hard as it is to talk about, those things do occur, right? And so it's important to have something in place for when it does.
Yeah, you definitely have to have a plan everywhere. It's just parts of life. So what are some of the other misconceptions you have heard about, SDIRAs, IRAs, still with Quest, or just in general, and that's put out there messaging wise? I mean, for those that maybe haven't heard about all of these strategies, backdoor Roth, backdoor Roth, I've looked at it, read about it a little bit, but for all those other people, just who know a little bit about it, but maybe have gotten misinformation, what are some of the other misconceptions or myths that you have heard that you just like to, like FAQs and things like that? People ask me, like, yeah, I hear that from time to time, but this is actually what it is instead. Anything come to mind around that?
Yeah, and there's certainly a few different things I think that come to mind when you mention that. One I would say is, believe it or not, the legality of the self-directed IRA. A lot of people don't think that it's really something that you can do or is illegal, which is really interesting. And I guess there's typically the way that I bust that myth is just, talking about our history. And Quest has been around for 20 years. We have over $3 billion in assets under administration, 25,000 clients. There's even certain areas on the tax form, and when we report on these account values on a 5498 that have specific investments or values related to real estate assets. So it's right there on the tax reporting. But that's a really interesting one. I would say there are quite a few things. I guess it just depends on how far down the rabbit hole you want to go, and especially with self-direction and government tax code laws, things like that. You can really get into some gray areas, which is a lot of times what creates that confusion, right? Is this right or wrong? And another big one I think I would probably point out to is a term known as checkbook control. So this is actually a particular way you can structure an account where your IRA, let's say, for instance, holds an LLC under it that you manage, where you are literally have the control of writing the checkbook. You make payments. That LLC then does all of the investments. It holds 3 different real estate properties and maybe is invested in this multifamily syndicator and holds some oil and gas or cryptocurrency, whatever it is, right? Everything happens at an LLC level. The issue with that a lot of people see is what the IRS calls having, or I guess 2 issues. But one, the IRS says you shouldn't have unfettered access to that qualified money, that retirement money, because it is for retirement. And it certainly, I guess, invites the ability for tax fraud, tax loopholes, being able to access that money without, skirting around the custodian, if you know what I mean.
Got it. Yeah.
And the second is that what we already talked about, providing a service to your IRA or IRA-owned assets is also something that's considered prohibited. So if you're the one managing that LLC, a lot of people would argue that is providing a service. So that's a pretty common one, and a question that we get all the time is about that checkbook control, whether it's legal or not, or how you can do it, what it looks like, what does it mean. Certainly a topic you can get really, really in depth on.
Okay. No, this has been outstanding, Collin. I've read a couple smaller books and, obviously dove into some of the resources, but in a world where there's, so much to keep track of and stuff, it's like something that if you're not revisiting all the time, you want to talk to someone who knows this stuff. right? And so who deals with it every day as a specialist, which you are. So I do appreciate it. We went through, some really fundamental foundational basics to some, really great strategies like the backdoor stuff, backdoor Roth, and you touched on the mega backdoor, which is an interesting one as well.
Mm-hmm.
Things that, you can invest in, some constraints, et cetera. I think we'll definitely have a part two for sure on things like, just diving deeper. I know things like UBIT is something that we hear a lot, right?
Yeah.
And we'll talk about what that is. Any final things you want to touch on? And then also, in addition, any last words around that, where can people find you?
Yeah. No, I mean, I think that's a pretty good holistic overview of what self-direction is, what these accounts can do, what different asset types you have access to with them. And there's, a few different ways you can contact me. Steven, I know you have my contact information.
Mm-hmm.
People can feel free to email me. My email is collin.taylor, just my name, collin.taylor @questtrust.com. So email is a great way to access. You can always look on our website. Our phone number, general contact information is on there. If you want to call in, have a conversation, happy to do that as well. We really just, are really keen on helping people and figuring out, what is going to be the best fit for them. So, however I can be a resource, I'm happy to do it.
Awesome. Well, I appreciate being here, Collin, and I look forward to the next time we have an episode and chat more in depth about these topics.
Yeah, absolutely. Thank you, Steven.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.